which that's what I would love to have. And then we'll build on this as we go along. Okay, guys, this is what we're doing. Off of this, we're going to start putting together some common sense trading ideas, which I'm calling it trading sense. Trading sense in developing your retirement, in your retirement savings, how you can make it last longer. So the way I'm going to open this up, first of all, and this is audience participation. How many of you guys in there all right, let me put it this way. How many years are you away from retirement? Number one question, how many years away are you from retirement? And I need some answers. And it may be that, okay. Thanks, Steve. Some of you may already be retired. Some of you may have 25 or 30 years. Jared, 4. Okay. All right, for me, in all honesty, I can't see myself retiring. And let me explain some of the reasons I'm going about this. Guys, I've been in the investment business in some shape, form, or fashion for 37 years. I've seen what has taken place over 37 years in the market. And Steve, thanks to you, a lot of this got triggered in the past 2 weeks, and it kind of added the flame to the fire when you mentioned diversification. I may never retire no matter what age, but I guess 5 years I want to slow down. Yeah, I understand that one, Dex. Slow down. I hope I don't slow down. I want it because I've seen, and I'm going to explain some things that go along that I think will make sense in what I want to build on, and I want to see off of what we've got, how pertinent some of the stuff we're going to talk about tonight is for ongoing. If it isn't, then I want to adjust it. I want feedback from you guys as much as possible, because this is going to be building to a giant webinar at some point in time. So if Pat at tradethesystem.com, that's my email, and you know, if you have notes, throw them out to me. Steve's always been really good about doing things like that, giving me suggestions. So here's what we're doing, guys. There may be times when we have 2 people in here. There may be times when we have 20. There may be times when we have 100. We're going to find out. Now, developing the trading sense to make retirement savings last longer. Investing strategically in today's market. Now, like I was saying, I've been in the investment business for 37 years in some shape, form, or fashion. I've been within the big brokerage firms. I've been in the small brokerage firms. And I've seen a lot of different suggestions come down the pike over the years that have totally been falsehoods. The investment community overall is only concerned with one thing. And what do you think that is? Commissions. You're absolutely right. Now, at one time, when I first started, it was really commission driven. And by being commission driven, I mean this. The brokers did very well. When I first started doing commodity futures, round turn commission was $80. And out of $80, a broker in a good firm, if he was doing enough business, could get over 50% of that commission paid to him. Then along came Charles Schwab, the discount brokers, and things started changing. And as it changed, the brokerage firms changed also. Of course, they started developing products that were pushed on us every week to sell. One of the ones that I got 3 different categories that we were sold so much hype on that it was, you were wanting to believe it if you're working, and this was Dean Witter Rentals, or Dean Witter. At the time, and I had worked with a small commodity firm called Clayton Brokerage, Dean Witter. I worked for E.F. Hutton for a short period of time. And then another place called Crown in that progression. And then just totally out on my own. And this is the way it worked. The first one that I feel like I got really built on was limited partnerships. Y'all remember those? These were the Reagan years that came along. And in the Reagan years, he pulled something that he changed the rules on limited partnerships and some of the taxation of it. Y'all remember that? I don't know if any of you guys are old enough for that. When they did that, they pulled the plug and lawsuits started coming in left and right after a couple of years. And what happened was a taxation on some of these. The write-offs were not the way they should. And because of those, up front, the brokers were making 8 to 9%, the upfront fee. And it tied up these funds for a number of years. One of the big ones that Dean Witter did was equipment leasing. Their equipment was this, and think about it, you guys who grew up in the computer evolution as they evolved. This was it. They were going to buy computer systems, big computer systems. The companies would run them for 4 to 5 years. They would sell them for more than they paid for them, or sell them to someone else and make a capital return on it. But along the way, the people who were renting this equipment would then turn around and rent new equipment. And it was going to be a steady flow of income. Guess what happened? Another one, public storage. what was the premise? I think they paid at one time close to 10% commission. Public Storage started out, they're going to buy raw land, they're going to build a building cheap, and their rents equal to, if not exceed, what an apartment building would be. And the only thing that they've got for an expense is a lock, some paint, and a light bulb. Makes a lot of sense. They'll hold the property for 5 to 10 years. They'll sell off the real estate. They'll take a capital gains on it. You'll be receiving income from the public storage, and the not the limited partner, but the general partner of the fund will make 20%. The broker's making 10, and then we're going to pay the rest of it back to the investor. BlackRock right now on a mutual fund, in some of their funds, they charge 1% and then take 10% of profits. There are a lot of different ways in the market, and I could go on and on. Another one is annuities. Brokerage firms now, if you're dealing with a financial planner, and if you guys have done that, how many, if you have, just give me a Y for yes and an N for no. And have they tried to sell you insurance? One of the reasons they do that is because insurance is where they can make their money. A financial planner. A financial planner is basically an insurance salesman in most cases. They do plan, but you've got to make sure that you don't take it hook, line, and sinker. And I could, like I said, I could go on and on, but let me do this. Developing trading sense to make your retirement savings last longer. All right, what are you going to do with what you've got, and how are you going to do it? Now, on the annuity, now getting great payment every month. Yeah. What are they offering on new annuities today? The new annuities, hey, we'll pay 3 to 4%. They may be up to some 5%. What are the costs in that annuity that you don't see? I read a book just a few months ago from, I think it got Bogle from Vanguard, and he laid out the plan. And if you haven't read it, you should. He reads out one thing that I knew all along. In the major brokerage companies, they may report, let's say, a mutual fund earning 10%, a 10% return. But he said it's simple arithmetic. He kept saying all through the book, simple arithmetic, simple arithmetic. Okay, he goes through simple arithmetic, and what is it? Simple arithmetic is this. When you start adding up all the cost and take their real return of what they've got, what they publish, and what they tell you they're making does not come out to the money that is in your account. He said that himself. In essence, they cook the books. So that's something to be aware of. And this is what I want to work on. I want to see where you guys are. If you've got annuities, really take a look at your annuities and see what your annuity is returning. Here's a good one. I know at Dean Witter, we had a lot of brokers in there that were taking annuities and putting them in retirement plans. or taking money in a retirement plan and buying annuity with it. The cost ended up being really amazing. The actual yearly cost that was passed on to the client. Now, here's something that it's time to think outside the box. This was a quote that I got when I picked up and was reading about diversification, Steve. Peter Lynch, dumb money is only dumb when it listens to smart money, to the smart money. Let me repeat it. Dumb money is only dumb money. It is only dumb when it listens to the smart money. Now, these are some of the things I would like for you to do and start thinking about. Retirement plans or retirement money, because what you can take right now, you can do a lot of different things if you're trading with after-tax money right now. And let me throw out a couple of things. What's your plan? Here's something I would like for you to consider. If you guys are trading, let's say, in equities, in options, with after-tax money, why not explore the possibilities of opening a Roth IRA and putting your after-tax money in the Roth IRA and trading equities and options in that? Because as it builds, whatever your time frame is, what happens when you pull it out on the back end? Can anybody tell me what happens with a Roth IRA? Yes, on the Roth, very good. No taxes, right. So even with what you've got, after-tax money, why not put it in there if you're putting together a portfolio that you want to see grow? Why not stick some money in a Roth IRA and trade it in there? The reporting is a lot less. And then when you pull the money out, and I've got something that we'll cover in the next webinar. It's the simplest thing in the world. It's called a 4-tick trader. But this is what I want you to do. I want you to start considering and start thinking about your plan. I want you to think about what your time frame is and what do you want to accomplish in your trading account. And are you content to stay the course that you're on right now? Those are some of the things I want you to consider. Next slide. Internet retirement questions. I went to the internet and pulled up a few questions just to get some ideas of the way the smart money gives you answers. Question, Paul asked, my nest egg is invested in a relatively simple portfolio of stock and bond index funds. What's a reasonable rate of return for me to expect in the future? Smart money answer. Given today's low interest rates, recently about 2.3% for the 10-year Treasury, and relatively rich stock valuations, Yale finance professor Robert Shiller cyclically adjusted PE ratio for the stock market recently stood at 29.2%, an average of 16.7% since 1900s. It would seem to strange credulity. That's a new word for me, to expect anything close to the annualized return of 10% for stocks and 5% for bonds over the past 90 years, let alone the dizzying gains of the market has generated from its post-financial lows, crisis lows. Onward, Vanguard recently published a 2017 economic market outlook in which the fund giant had a median forecast for the next 10 years of 6.6% for stocks and 3.1% for bonds. And here's your smart money response. Get this one. And of course, costs are a major factor. Yes. Research from Morningstar shows that here's the epiphany for you guys. The less you pay in investment fees and expenses, the higher your returns will generally be. Does that knock you out of your seat? That's from Morningstar. Next up. Let me make sure I didn't pass one. Oh, wait, here we go. This one's great. If you're already retired, then the right way to deal with lower returns may be to pare living expenses where possible, tap home equity by downsizing, or signing up for a reverse mortgage, taking on a part-time job, or even relocating to a part of the country where the cost of living is lower. I saw an article the other day where there's a guy, retirement cruises. Some people are choosing, instead of going into a retirement home, they're basically staying on a cruise ship almost 365 days a year. They've got a room, they've got somebody to clean up after them, they get meals, basically all the food they want, they've got people around them all the time, they've got entertainment, they've got different places that they can travel. And they're now beginning to put cruise ships together with a big portion, or a portion of the cruise ships segmented out for people who want to live on the cruise ship. Now, how encouraging is that from the smart money? This is what we do. Downsize, move, do a reverse mortgage where they get the biggest majority of the money than you do, or take on a part-time job, relocate around. I bet they even have a small golf cart that they can drive around on. They've got this guy said, that he's got a scooter thing that he can ride any place he goes. And he gets to go to different places all the time. Now, next one. Or here's another one. You can choose to ignore the possibility of muted returns in hope that the forecasts are wrong. But the more prudent response is to start fine-tuning your retirement strategy now to reduce the chance that you'll have to take more drastic measures later on. Question. Define fine-tuning. Smart money. Now, my question here, you've seen these in all the investments, your nest eggs. Are your nest eggs cracked? For a lot of people, they are. And the reason is because we buy into what the smart money says. CNBC, they've got all the answers. Some of these people hadn't been out of school 5 years. Like I said not too long ago, I've got shoes that are older than these people. Seen some of the ones on CNBC and the financial sides. I've got shoes older than them. They probably don't have a clue. They're up there, they're earning a salary, they don't invest, they don't look at returns, they plow money into a 401k, they're probably getting it matched dollar for dollar. For every dollar they put in, they're probably getting it matched a dollar. That's a great return. If you can do that, man, plow money into it, all you can get. And then tell them a few years down the road, hey, I want to take over and manage it myself. Because the 401k, they're doing everything that they can do to keep the returns at a point where they don't get sued because of their fiduciary responsibilities. And you can quote me on that. That's what brokers are concerned about now, the fiduciary responsibilities. Like the Department of Labor was going to take it over, where brokers were really going to be hammered until Trump got elected, and they said, we're going to change it back, because Obama had put it in there where basically the brokerage firms were just going to be getting sued every day by somebody who said my returns weren't enough. So, are your nest eggs cracked? Next. All right, when there's never heard an encouraging, that should be word, an encouraging word. Rate of return might be more of 5 or 6% based on your overall risk tolerance in a portfolio. This is what, basically going back to it, what can you expect on some of the returns? Certified financial planner Stacy Francis of Francis Financial in New York. So plug in 5 to 6% of your money and see what that comes out to be. Baby boomers today need to look at a rate of return in shorter time frame horizon. He believes retirement projections should be broken down into 3 rates of return on a pre-tax basis. Taurus assumes equity returns of 5%, fixed income of 2.5 and 3%, or 2.5 to 3%, and cash at 1/4 to 0.5% return. Senior portfolio manager at Soho Asset Management. So that's what their expectations are. They set the bar high, don't they? Now, no magic number. There's no magic. This one's another one I picked up. No magic number, but many Americans can assume that they'll need 80 to 90% of their current expenses in retirement. That should factor in medical expenses as well as any additional income, including Social Security payments or perhaps an inheritance. So there's no magic number of how much you're going to need. Now, there's another one that you can go to. Retirement financial calculators. Y'all seen these? Start plugging numbers in. Here you go. 25 years to retirement. A rate of return is 7%. Your initial investment of $100,000. Additional investment of $1,000 per week. Expected inflation rate of 2.9% and a tax rate of 15%. Now, if you do this after 25 years, you'd have $3.3 million. How's that float your boat? So you got to start with 100,000. And $1,000 per week, or $4,000 a month that you're putting in for your retirement. Is that reasonable? For some it is, for some it's not. I know when I was probably, let's go back to when I was probably 25 to 30 years old, that would have been totally unheard of. Now, guarding against what? But when it comes to guarding against an unfortunate sequence of returns, let's remember that the 4% rule was designed to incorporate the very worst retirement periods in history. Even if a retiree is extremely unlucky and sees their worst returns early on, the 4% rule will work. This person had said, use 4%. Now, let me ask you this. With your retirement funds that you have, can you operate off of 4%? Now, what I'm going to do as we go forward here, developing trading sense to make your retirement savings last longer. This is going to be an ongoing webinar every week. I'm going to start introducing things in here that will not make your head swim, but it will take all of these smart money predictions and put them in a different category. We're going to have Larry come in and talk about some of the stuff he's doing. We're going to be taking a look at this, and we'll be doing this. I've got it already penciled in every Thursday at 7 p.m., and I will record these. But going forward, I'm going to have my video camera also set up to where I can talk to you face to face. We're going to be doing some of these things. And the reason I'm doing this is this. You know, if you put a pencil to it and you see that I've been doing this for 37 years, and you assume that I didn't start out when I was 20, let's say 20, 25 years old, you'll kind of get where I am. I want to help you guys no matter where you are with your investments to get to a point where you can start working on improving your situation. For this reason, you may want to make more money to give away. You may want to make more money to give to your kids when you're gone. You may want to make more money to buy you a house someplace. Different things that you want to do. And we will take a look at some things that would most likely be written in notebooks. Some of the strategies in not you may be able to find it in a few obscure books in a library someplace. But we're going to start thinking outside the box, guys. We're going to start looking at different ways to build accounts, whether it's retirement or just a trading account. We're going to look at different ways to build them, whether it's in futures, whether it's in equities, whether it's in options, whether it's in cryptocurrency, whether it's in no matter what you might take a look at. Now, I would like for you guys to do this. You've signed up. I will start building a list, and I'll send out the list for all you guys every week. And as we produce some answers, I want to start recording some of these answers from you guys. I want us to build some trading plans. I want to put together some long-term scenarios of what you're looking at and begin to start investing, as I put on the opening slide, strategically in today's market. We're going to hit a bear market at some point in time. I want you guys to be prepared for it. I want you to thrive in a bear market. I want to teach you how to trade bonds. I want to teach you how to hedge bonds. I want to teach you how to hedge portfolios. I want to teach you some of the things that we've done in outright futures trading. I want to teach you some things about spread trading in futures, spread trading in equities, spread trading in options. And all of this will cost you nothing. This is going to be free training, and it's going to be podcast, and I will probably go about an hour every week. What does everyone trade in the trading room? Jared, most people trade futures and options. But there are a lot of different ways. And then I would say we go futures, and I think options and then equities. Probably in that category. Currencies, yeah, DEX currencies. We will be touching on currencies quite a bit along the way. There's a lot of opportunities to take what you're doing. And I think with the things that are going on right now, with the market heated up the way that it is, if we prepare ourselves, there's a lot of potential in here in the months to come for us to start building something that you take a look at and that you can use for a long time. Number one of don'ts: don't invest in mutual funds. If you're in mutual funds, my recommendation would be get out and get in ETFs. Get in low-cost ETFs. Get in an ETF that you can trade in and out of. Get in an ETF that allows you, that has some options where you could also protect yourself if the market's going up and down. You could pick up make options like a dividend play. Now, my question is this. If you've got, and let's use $1 million. If you've got $1 million account at this point, are you willing to assume this 4% rule and live on $40,000 a month or $40,000 a year before taxes? How do you find good ETFs? Great question, Jack. We are going to take a look. That is one of the things that we will do. We will start looking at ETFs, and I'll show you some of the ones that right now, and let me pull this up, and this will be a great one to kind of transition out of as we go. Here are 10 sector funds here. The sector funds cover consumer discretionary, covers technology, consumer staples, communications, utilities, industrial stocks, real estate, bonds, energy, all of that. The key off of what Boger, whatever his name is, from Vanguard, you need to be looking for extremely low cost ETFs. And I knew this when ETFs started coming along. I said, with what ETFs do, why would anybody want to own mutual funds? And along the way, I believe that's true. Take a look at some of those, guys. Good exchange traded funds. And one of the things that I think will help more than anything, to touch on a little bit, we start coming up with a plan and introducing some, I won't deviate from this process because it works, way to increase any type of investment return that you're holding for the long term based on cyclical moves of the market. And I'm going to show you one of the key money makers that you have in the next webinar. And I'll tell you what it is now. One of the key money makers that you will have along the way to develop long, short, in, out, whatever you want to call it, is a 100 period simple moving average. You'll be astounded by using that of developing bullish or bearish, in or out, aggressive or non-aggressive along the way. You'll begin to see some things that you'll go, man, this could be huge. It will take that 4% rule and you'll throw it out the window. Believe me, like Peter Lynch, here's a guy who was running one of the biggest mutual funds in the business. Dumb money is only dumb when it listens to smart money. You can't listen to the people on Wall Street. I did that. I was one of them. I was one that people listened to me. And I still have guilt feelings on some of the ones that we've gone through. Guys, I'm not blowing smoke. I'm telling you the truth. These are things that the financial industry doesn't tell you, because it would begin to cut into their money that they're making. They make money no matter what. They're going to keep making money no matter what. The amount of money they get when they introduce an IPO, the amount of money that they make when they do are they making money on commissions? Not much. They're making money on management fees. That's why at Dean Witter, in all the major brokerage firms, started going to salaried employees. Why? Because, what were you going to sell to make money? There were times when we had, you'd do 100 shares of stock and you'd charge $100, $150 for it, commission-wise. Try that now. Guys, I've been there. I've done that. I've been there. I've had that Kool-Aid. Does this sound like something that will be in, and this is going forward, and I'm going to have to make some major adjustments along the way, I'm sure. Does this sound like something that would be worth spending your time on? Yes, yes, yes. There's 3 yeses. Cheryl, JM, Jared, Jinu. Now, let me throw something out as we wrap up here. Different opportunities are welcome. Yeah. That's what I want to jar us out of our I just kind of jar things, whether it's trading futures or whether it's trading options or whether it's trading equities. I want to take a look at it as going, all right, what I want to do is make money. That's what we're here for. Afraid to invest your retirement money. See, a lot of people are, Wayne, but the problem is this: if you don't invest it wisely, then the inflation is going to be eating away at it. Do it smart, and all of a sudden you're killing the inflation and you don't care. you're doing it wise. Am I saying take everything and do it? No, but just look at it in sensible ways and start coming up with a plan and saying, okay, this is what we're going to do. Yeah. Yeah, that's what I want to do. I mean, you don't have to take the advice, but if it's something that you can pick up and use along the way, can you take something as crazy as futures and add to a portfolio to where it could produce, you could get to a point where you could start on a 5-year plan, and I'll explain this in the next one, with a $5,000 account and work on what I'm talking about, and in 5 years have over a $50,000 income coming out of that $5,000 investment. Yeah. With your plan, can you gravitate toward your comfort areas? Mine is equity, futures, and commodities. Yes, you sure can, Jack. That's what we're going to do. And what you will develop along the way is this. You'll develop different skills, and that's what I'm here to do. I can't promise you anything, but I can help you develop skills that work. Skills of not listening to smart money, because most of the time they're wrong. And let me drop this one on you. Guys, when I was at Dean Witter in my early years doing futures hedging, they had a guy in there named Bill Dodge. Bill Dodge was an honest guy. He came in, and in 1987 probably. Any of you guys remember some of the years that we had right around 87? If you read about it, things got a little bit hairy. I think it was 87. Bill Dodge came in and started putting sell recommendations in Dean Witter's investment, their master investment strategy newsletter that they sent, first of all, to all the brokers, and that the brokers would usually take them and send them out to clients. He started putting sell recommendations in there. You know what happened to Bill Dodge? They fired him. Because you don't ever, in the brokerage firm at that time, you don't ever put out sell recommendations. It may spark some fear and people may pull their money out. That's what they were doing. He gave honest investment advice and they fired him. I was in there when they did the junk bond funds with the guy who, what's his name? I know it as well as I know my own name. Help me out. Yeah, everything was buy and hold, Dex. Everything. Buy, hold, don't sell. But I guarantee you, in the investment portfolios that they were doing, they passed along the sell information to the institutional people before the retail people ever got it. The major brokerage firms in the United States and probably all around the world are only out for one thing: to keep money in the account and get the management fees off of it. Who was the guy who went to jail for the junk bond portfolio? Yeah, Milken. I can't tell you how many sales presentations and how many contests that we had to see who could raise the most money for junk bond funds, because there's no way they can lose money. All of them aren't going bad. You know what happened? I know some people who put them in at $10 a share and got out at $1. And you know what? Dean Witter got their butt, and everybody else in the junk bond business with Milken, everybody else got their butt totally sued. And I had, one lady off of a limited partnership sued because she made 8% return, but then she thought she should have gotten more. And Dean Witter's checkbook was at the point where they didn't even want to fight anything. So you could sue even if you made money, and they'd pay you what you ask. And the poor brokers were just hosed. They didn't give you a say-so. They didn't give people a say-so on anything. They just opened up the checkbook and said, deal with it on your record for the rest of your life. But we aren't claiming that we've done anything wrong, but we'll give you money. And that's the way it worked. So got in Milken with the junk bond funds, same thing. Limited partnership. You remember the wind turbines that are out so prevalent now? They even had those in limited partnerships. I wonder if anybody ever made any money off of them. So the thing is your financial independence. I want to help you guys, and along with me, because this is going to sharpen me up even more too. It's going to make me work a little bit harder. I've been in the business and around that business for such a long time that I know there's some things that are going on that, I don't want to do it for a flash in the pan. You're here for 3 months doing something and then you're gone. I want to develop something in here where people are seeing and sharing ideas, kind of like Larry, where people begin to share ideas that makes us think outside the box. So guys, I'm going to cut it off. I've gone an hour, and let me stop the recording.